With all the recent changes to the budget, is property still worth investing in Australia? Today we're going to dive into it. I'll be breaking down what changed in 2026, the hidden costs people forget, the real numbers from our investment property, and whether I think property is worth investing in or not, and how it compares to ETFs and shares. And if you're new here, hi, I'm Queenie and I'm a personal finance creator. I have a license to give general financial advice, but keep in mind that anything that we talk about in this video or on this channel is general advice only and not personal financial advice. You can read my full financial services guide in the description. So sit back, relax, grab a drink of your choice. Today I'm drinking some black tea and let's dive in. And to get all the numbers for this video, I'm using my budgeting and expense tracker app Billroo. It helps me see exactly how much money I spend on my property versus how much I earn in rental income. And we've also added a new feature where you can start tracking your net worth too. So if you would like to try it for yourself, I've got a link in the description below for a 14-day free trial. And I also got a new mug as a little gift for myself. So first, let's talk about why property is appealing. Australia is seriously obsessed with property. I feel like since I grew up here, it was kind of normal and part of our everyday culture, but I have noticed with a lot of my friends that live overseas, they really don't care about property all that much. It feels like a lot of us in Australia are all trying to save up to buy our first home or trying to buy an investment property. But overseas, people are quite comfortable with the idea of renting, and a lot of them don't even have goals to buy their own home. And I've noticed just generally a lot of people overseas don't really see property as big as an investment compared to shares and ETFs. At least that's my observation. I'm curious to hear what you think down in the comments below. And I do understand this mindset for sure. Property is a physical asset, so you can see it, you can touch it, you have options with what you can do with it, you can live in it, you can rent it out, you can renovate it, and you just have this comfort knowing that you have a physical asset that is yours. And it can definitely build wealth through capital growth, rental income, and also leverage. Something that I find quite interesting is Australians have one of the highest median net worths in the world. In a lot of lists, we either rank second or third. In this example, we're ranked second with a median net worth of $268,000 per person. Also keep in mind that I am mentioning the median net worth, not the average net worth, because if we look at the average net worth, Australia is still pretty high up on that list. But I guess because our wealth is more evenly distributed and we don't have some crazy high net worth individuals here, skewing the averages too much. So yeah, that is a pretty interesting fact. And one of the reasons why Australians have quite a high median net worth compared to a lot of the rest of the world is because of a few reasons. One of the reasons is our compulsory superannuation, and another reason is because our property prices have really just risen so much over the past 20 years. In saying this though, while I think property can be a good investment, I don't think that all properties are automatically a good investment, and you still do need to run the numbers on them just to make sure that they check out. Because while properties can go up in value, they can also cost you quite a lot of money along the way. So now let's talk about what could change for property investing in 2026. As of the 4th of June 2026, the RBA cash rate is sitting at 4.35%, and according to data, the average housing loan rates are roughly 5.9% per year to 6.6% per year depending on the loan. This means that mortgage repayments are quite a lot higher than they were a couple of years ago. We bought our first home back in 2020 and the cash rate was basically zero. So the interest rates that we were paying back then were around 2%. It's honestly crazy to see where they are now just a few years later. Higher interest rates mean that people generally have less borrowing power, and deposits can still be quite hard to save because property prices in Australia are still quite high. And there have been quite a few new proposed changes to the budget as well. The government is looking to make changes to negative gearing and also the capital gains tax discount. If passed from the 1st of July 2027, negative gearing for residential property will generally be limited to new builds, with properties held before the 12th of May 2026 expected to be exempt. So basically, if you've held a property before the 12th of May 2026, you can still negatively gear those properties, but from that date onwards, you may only be able to negatively gear new builds and not existing established homes. And if passed, the current 50% capital gains tax discount would be replaced with an inflation-based system, plus a minimum 30% tax rate on capital gains. With the new negative gearing changes, here are some potential impacts for property investors. If you're looking to purchase an investment property and it is negatively geared, generally, a lot of banks have changed their criteria around borrowing, and it does generally mean that you might have less borrowing capacity compared to before when you were able to take into account the negative gearing tax benefits. And with the new capital gains tax changes, it may mean that you need to pay slightly more tax when you do sell your investments for a profit. Here's a simple calculator from Perla that I found. Let's say you invest $100,000 and you hold this investment for 15 years and you get an average yearly growth of 7% per year, and your taxable income before capital gains tax is $90,000. With the old 50% discount model, that means that when you go to sell, your asset would be worth $276,000 and the raw capital gain would be $176,000. Under the old 50% capital gains tax discount, you would pay around $29,400 in tax, but with the new indexation model and the 30% floor, you may have to pay $45,600 instead, which is a difference of roughly $6,000 in tax. I'm personally in two minds about these new changes. Firstly, I do understand where the government is coming from. Housing affordability is such a huge issue in Australia, and property prices have just risen so fast over the last 20 years. Wages just haven't really been able to keep up. So I do think something needed to change in order to address this. But at the same time, I don't understand why these capital gains tax changes weren't just applied to property and why they also include shares, ETFs, potentially even the sale of businesses and startups as well. Because I feel like in a way it doesn't really discourage people from investing in property because the capital gains tax changes will be applied equally across all assets. But at the same time, I don't necessarily think it is fair that people that earn an income from investments are getting taxed less than people that are earning an income from their wage. So I do understand both sides, but I also feel like if the government does want to make these changes, they should also look at reducing the income tax rates as well on working Australians. But those are just my thoughts. I'm curious to hear about what you think down in the comments below. I've also had a few weeks to sit on these changes and to really think about them, and personally it hasn't really changed my investing strategy all that much, because at the end of the day, if I'm paying capital gains tax, it means that I've made a profit, and that's the whole goal of investing at the end of the day. I still want to make as much profit from my investments as possible, even if it does mean paying slightly higher taxes. But I'm curious to hear from you. What do you think about these changes in the comments below? And I guess in terms of property investing specifically, I don't think that these changes really kill property investing completely, but I do think that the negative gearing changes specifically will impact property investors because people will generally have less borrowing capacity when they look to apply for loans because they're not able to take into account those negative gearing benefits. Keep in mind that this is general information only and not personalized tax advice, so it's important to speak to a registered tax professional about your situation. We've actually recently refinanced our home loan and we saved around 0.15%, which doesn't sound like a lot, but over the lifetime of our loan, it will save us a lot of money. In fact, a 0.15% reduction in my interest rate over the lifetime of my $680,000 home loan would save me around $66 per month, or around $24,000 over the lifetime of the home loan. And even if you choose to refinance, you can still choose to have the same amount of time remaining. So let's say, for example, you only have 24 years remaining. When you refinance, you can still choose to have the loan term be 24 years. And if you would like to see if refinancing could save you money, or if you would like to chat to a mortgage broker about getting a home loan, I've got a link in the description below so that you can be matched with a mortgage broker. So now let's talk about leverage and risk. One of the biggest advantages of property investing is leverage. And leverage is basically using borrowed money to invest. Let's say you have $100,000 and you could choose to invest the $100,000 in ETFs or the $100,000 in property. Generally, if you invest $100,000 in ETFs, you only control $100,000 worth of assets, compared to generally when you buy a property, you can use that $100,000 as a deposit, and then you basically get to control a $500,000 asset. And this is where property can become quite powerful. If your $500,000 property goes up by 10%, that's $50,000, which is a 10% increase on the property value, but compared to your $100,000 deposit, it's a much bigger return before the costs. And that's why people love property, but it also does work both ways. Your costs can also be magnified with property, and your losses can also be magnified with property. If the property falls by 10%, that's a $50,000 drop. And if interest rates go up or payments go up on your mortgage as well, the costs are definitely magnified with property, especially when you take into account things like stamp duty, if you are looking to get a buyer's agent, real estate agent fees, solicitor fees, conveyancer fees, building and pest inspections, and more. So generally when it comes to property, you do need to hold onto the asset for quite a long time in order to recoup some of those big costs in the first couple of years when it comes to property. I actually ran the numbers myself in Claude and I found this super interesting. Highly recommend anyone do this. If you you are considering whether to invest in property or shares and ETFs. This is not sponsored, by the way, I just think that it's such a great tool. Let me show you how it works. So I wanted to compare investing $100,000 in property versus $100,000 in shares and ETFs. And here's what it could look like over time. With $100,000 to invest in property, once you deduct things like stamp duty at $19,000, $4,000 for other costs, we've basically got about $77,000 for the deposit on the property, which means we'd be buying an asset worth roughly $400,000. So let's have a look at how the math works out. If we assume that the property grows by roughly 4.5% per year, so the ETF line is the green line and the property line is the blue line. If we assume a $400,000 property that grows by roughly 4.5% per year, on the alternative is investing $100,000 into an ETF, which returns roughly 8.5% per year. We're assuming the rental yield is 3.8% per year and a marginal tax rate of 37% per year. We can see here that the ETF net worth is ahead, but then it crosses over around year 14 and then property comes out ahead after that. And that's what I think we need to keep in mind when it comes to property investing. If you are looking to invest in property, you do generally need to keep it for quite a long time, say usually more than 15 years or more, in order to make back some of those costs that you made for that purchase. Whereas when it comes to shares and ETFs, yes, you don't have the leverage effect because you're only controlling a $100,000 asset, but because the returns are generally higher, these returns can really compound and grow over time. And sometimes they can compound even quicker than property, even though property has that leverage effect. And especially if you do have a slightly shorter investing horizon, ETFs and shares can still make sense, as we can see from these numbers. But of course, if you do change any of these assumptions, let's say for example the property grows by 5% per year, then it takes less time for property to come out ahead of shares and ETFs. But let's say, for example, shares and ETFs perform even better, then property takes a lot longer to catch up. And of course, if the property only grows by 4% per year, then it never really catches up with shares and ETFs. And it generally just underperforms investing in shares and ETFs. So that's definitely something to keep in mind if you are considering whether you want to invest in property or shares and ETFs. And I'm curious to hear from you, which investment do you prefer, property or shares? Let me know in the comments. And there are the costs that people forget. I think this is one of the things about property that a lot of people forget to mention. When people talk about property, they usually say things like, I bought this place for $500,000 and now it's worth $650,000. And that's amazing, but the real question is, how much did it cost to get there? Because property has so many hidden costs. You have stamp duty, conveyancing, mortgage interest, council rates, water rates, strata, insurance, repairs, maintenance, property management fees, vacancy period, accounting fees, and potentially land tax. And then when you eventually sell, you may have to pay real estate agent fees, marketing fees, solicitor fees, and capital gains tax. So when somebody says their property has gone up by $150,000, I think it's important to actually calculate the profit after the costs and the tax. Because buying a property can sometimes be like buying a really cheap flight. It sounds amazing until you realize you need to pay for bags, seats, food, transport to the airport, and emotional damage from waking up at 4 a.m. or doing a red-eye flight. So sometimes the price of the property itself is not the full picture. And that's why I think it's easy for a lot of people to overstate how much money they make with property, because there are so many costs that they pay that they honestly just forget about. So I think if we are investing in property, it's good to kind of think of it a bit like a business. What's the income? What are the expenses? What's the vacancy rate? What's the cash flow? How much risk is there in this property? And also, how much effort does it take? Because property absolutely can build wealth, but it's not always as passive as it seems. And even with a property manager, you're still the owner, because if something breaks, it's your problem. And if there's a special levy, it's your problem. So property can be amazing, but it's not free money. So now let's get into our actual property numbers. And a quick clarification here, the rental income number that I'm using here is not the gross rental income before expenses. It's actually the rental income that came through our property manager, and all of the deductions have been taken out. So our property manager collects the rent, then they take their commission, which is 5%, and then they also handle some property related bills for us with that rent. So things like council rates, strata, water bills, and some of those other costs through the agency. So what comes into our bank account is the rent after all of those expenses have been paid. So for example, in our recent statement example, the rent was $2,700, but after the council rates, admin fees, and rent commission, the payment to us was $2,023. But then again, there could also be other costs outside of these fees that we pay. For example, mortgage interest rates, insurance, repairs, depreciation, and tax. So I just wanted to give you some context about our investment property. Pablo and I bought a 2-bedroom apartment to live in ourselves back in 2020, but in 2024 we wanted to buy a bigger home to live in, and we decided to keep our apartment as an investment property. So this wasn't bought as an investment property from day one, it just became one later. And this is important because if we were buying it purely as investors, we may have bought something different. So we wanted to still hold on to this property for a reasonably long period of time because there are so many expenses that come with property, and we really just wanted to wait it out a bit longer. And this is actually where our budgeting and expense tracker app Billroo has come in really handy, because we can see exactly in our income and expenses exactly how much rental income we've made for the property and exactly how much this investment property costs. And if you want to try Billroo for yourself, I've got a link in the description below to a 14-day free trial. So in 2024, it wasn't rented out for a full year, so we don't have a full year of data, but we did spend $12,900 on the investment property, and we received $9,858 in rental income. So the rent covered about 76% of those property payments, and the gap was around $3,000. So this worked out as roughly $600 per month out of pocket in 2024. But then in 2025, we had a much more cleaner look because we had a full year of data. In 2025, we paid $34,529 to the investment property mortgage, and we made $27,630 in rental income. So the rent covered about 80% of the mortgage, which means we paid roughly $575 per month out of pocket. And this year to date, the numbers have improved even more. And so far this year, we've spent $13,499 on the investment property costs, and we've made $11,800 in rental income, which means our out-of-pocket cost is around $1,600, which is around $329 per month. So rental income is covering roughly 88% of the costs. So the cash flow has definitely improved on the investment property over the last few years. And since we bought it back in 2020, it's grown by roughly 5 to 6% per year. While the rent didn't fully cover the mortgage, it did help us build equity in the place, and the property itself has grown in value. And it also gave us options with where we could live. We could choose to live in that place, we could buy another place. So yeah, I think it's great that it gave us some options, and we are very, very lucky and grateful to have it. I definitely think if you do live in an expensive city like Sydney and you want to get your foot into the property market, buying a starter home that you can afford and then upgrading later could be a smart strategy. Plus, you could also potentially save on stamp duty fees and buyer's agent fees. But personally for myself, I do prefer investing in shares and ETFs. They're so much easier to manage. I love how I can buy them whenever I want to. And I also feel like as the housing crisis does intensify a bit, I feel like I don't really want to be buying excess properties when other people could be buying them as homes to live in. I don't think there's anything wrong with having an investment property, but I do just prefer to invest my money in more productive assets like shares and ETFs, opposed to property, which can be a bit more of a non-productive asset. And also when I was running the numbers for myself, as you saw earlier in that example, it didn't really jump out to me that property was always a better investment than shares and ETFs, even with the leverage that you can get from property. Simply because the cost of buying a property can be so high, it takes so many years for the property investment to actually outperform shares and ETFs. And then sometimes if the property does underperform, it might not ever outpace shares and ETFs. But of course, it's important to do your own numbers as well. And there are definitely some properties that have done really, really well and have had amazing returns. But yeah, that's just my opinion. I'm curious to hear about what you think down in the comments below. I do like having a bit of both in my net worth mix, a bit of property and a bit of shares and ETFs, because I do like to be diversified. Something that I love about Billroo is being able to ask the Billroo AI all of these things and to really understand what our numbers are. All the numbers that you have seen here have come from the Billroo AI because I can just really easily get a snapshot of exactly how much I've paid to my investment property versus how much it's brought in. And it can easily work out the percentages and how much of the rent covered the mortgage, and it's really amazing. So let me just show you how it works in action. So as we can see here in 2024, the investment property costs would be around $614 out of pocket per month. 2025 was $575 out of pocket per month. and 2026 so far has been $329 out of pocket per month. I just love being able to use the Billroo AI to find these numbers super quickly. So here's my final verdict. Is property still worth investing in Australia? My honest answer is yes, probably, but not all the time, and it's not for everyone. Property investing can still be worth it if the numbers make sense, if you can handle the debt and the out-of-pocket costs, and if you have a long-term mindset and want to keep it for a really long time. It can provide rental income and it can grow in value over time, and it can give you options later on down the line, especially if you do something like what I did, buying a starter home and then upgrading later over time. But property isn't always automatically better than ETFs, because sometimes, as we saw in the calculator before, it can take a really long time for property to net out ahead of shares and ETFs just because of the high upfront costs. But of course, if you do have a really amazing performing property, then it can absolutely outstrip shares and ETFs much faster. But personally, I do like having a bit of both. Property does give us leverage and stability long term, but I also really like ETFs because they're simple and diversified and very easy to buy and sell. Don't forget, if you would like to see where your money is actually going, you can check out Billroo, our budgeting and expense tracker app, in the description below. I've got a link to a 14-day free trial. Thank you so much for watching this video all the way through. Your secret word is bricks. So write us a comment below with the word bricks in it, just so we know you watched this video all the way through. Thank you. Bye.